I think we're at the new cycle point. The logarithmic chart, we got to the 2 standard deviations oversold. Everybody knows the on-chain metrics. We've got the perfect setup. Is it today? Is the low in? I would give it an 80% probability, but there's a 20% chance it's not. So I'm very focused right now on watching the price structure. And the final thing to give you is the big one for me is ETH breaking about the 2000 level. That would give us an inverted head and shoulders low. And also there's a downtrend from the high, and it would have then broken a wedge pattern to the upside. And that would be the start of the run to new highs whenever that occurs. Macro backdrop, that's where we start. The macro backdrop, the thing that drives crypto that everybody has now learnt is the adoption cycle. So how many people are adopting? And we're seeing, for example, the number of wallets in Ethereum and stuff go up, but the overall activity of these networks are pretty stable. They came down from peak, they've remained stable, and that's why the price action's been sideways, trended lower in the summer as we had all of the CeFi shocks. But the main driver of all of this is liquidity. Liquidity drives all financial markets. Liquidity, for the definition here, would be the kind of ease of which money flows around the system. And I can use money supply growth, M2 growth globally. And obviously with the central banks all jacking up rates and shrinking their balance sheets, what they're actually saying to you is we want to take liquidity out so you guys can't do as much speculation. Now, what that means is things like your credit card rate goes up, your mortgage rate goes up, you've got less money to spend on stuff. So liquidity, your liquidity has been taken out of your pocket. And it's the same for everybody, particularly because there's so much debt in the system. However, our job is not to live in the present. Our job is to live in the future. And we need to understand where the future lies. So Stan Druckenmiller importantly said that the job in macro is to see 12 to 18 months out, because the asset markets tend to price the future. So right now we can hear people all on Twitter saying, we're going into a recession. It's clear there's going to be another leg down in equities because they need to price in the recession. That's assuming that everything operates in real time, but it doesn't. So when I look at the year-on-year rate of change of, let's say, the NASDAQ, and compare it to the ISM index, which is my guide to the business cycle, the Institute of Supply Managers survey, it suggests that the ISM survey, the NASDAQ is pricing in ISM at around 40. ISM at 40 is relatively deep recession. ISM at 47 is usually a recession level, and 40 is something, to the order of magnitude of kind of negative 2% GDP growth. So it's already priced in. The S&P is similar. Things like copper are close, oil less so, but coming down over time in line with the business cycle. The exponential age stock, so the long end of technology, the ARK style investments, they priced an even deeper recession. So they got down to about 35 in the ISM, which was very, very low. So I think the market's discounted this already mainly, and that the low potentially is in, because what will be happening in 12 months' time? In 12 months' time, we will have seen a recession and we will likely be coming out of it. Whether we're fully out of it or not, doesn't matter. A recession at some point in the future means that the Federal Reserve will stop hiking and will stop shrinking the balance sheet. And they will probably go towards cutting. In the future, in 12 months' time, the probability of inflation being, at 8% is extremely low because of the year-on-year computational differences and the fact that oil, copper, freight rates, everything has come down massively. So I'm thinking that there is a probability that inflation goes negative within 18 months. So if we look out 12 months, the recession is behind us, rates are lower, and inflation is low. Okay, so that is a very good outcome for risk assets and crypto. Crypto bottomed in June. We had the retest. Bitcoin had a retest only 2 days ago, and I think it was the retest. So my DMARC indicators, which I use mainly for my technical analysis, gave me that signal. ETH had a much stronger signal in June, and I started finding as much money as I could under the sofa anywhere to start investing, adding to my positions. I never sold anything. I'm thinking the markets are forward looking. I think the sentiment is extremely bearish, and we're going into a potential change in the macro. Does it happen this month, next month? Don't really care. Then we've got the ETH merge, which we all know about. You know, I don't think it brings fireworks. Maybe it does. Maybe there's a big sell-off after it, big sell-off beforehand. I don't really know. And again, I don't really care. What I do know is that post-merge, a few things happen. There are no miners to sell every day. That's about 6 billion that just disappears from selling each month. Okay, so that's a difference. Then we've got the reduction in supply, but that's really driven by the increase in network activity. So we need to kind of see the network go up a lot for that to really kick in. It become deflationary, but it's less inflationary. So there's less ETH around, but then we've got this magic. The magic is you've just introduced yield into the ETH ecosystem in a secure way. So therefore, because it's at protocol level, so therefore this is going to attract new people into the ecosystem who want to get ETH for yield. So you've got a demand shock. Also the lack of the ESG restrictions that people have with Bitcoin, you know, falsely so, but I understand that that's the mandate people have got. So you've got people who are frustrated who wanted to invest but couldn't because of ESG and Bitcoin. The ETH merge, they're waiting for it to happen. ETH now has a yield. A lot of institutions don't own gold because it doesn't have a yield. So you've got this technology asset that represents a big, exciting future with a yield, with a limited supply. So that has and a macro that's changing. That to me suggests the next 12 months probably very, very good for digital assets. So that's at the basic level. And then I'm trying to think through, okay, in a new world where ETH is this very important asset, it's still going to have problems. It's still going to be expensive and it's still going to be slow. So as adoption keeps building, a lot of adoption spills outside of the ETH into the Solana, Avalanche, and a bunch of other protocols as well. So I think we're going to see ETH lead the charge, and then we'll see this tail of stuff starting to come as we start a new bull market. And generally things work that way. So I think a lot of these layer ones this time around will be like ETH in the last cycle. They'll end up becoming very large dominant change. Which ones? Don't really know. My bet's really on Solana, but it could be any of these, and I'm kind of indifferent right now. Solana's, as I said, I got more allocated towards that than I have to some of the others, but I'm watching them and waiting to see. I've had also technically a perfect monthly, daily, weekly demark setup in the Solana ETH cross. Now, I'm not yet ready to make the bet that I would switch my ETH into Solana, but I have some. But I'm observing that to say, let's see if that plays out, because that will be a narrative that people don't really expect. And I'm not saying that Solana becomes bigger than ETH or anything of that sort. I'm just saying, could it outperform in this cycle? So I think we're at the new cycle point. The logarithmic chart, we got to the 2 standard deviations oversold. Everybody knows the on-chain metrics. We're like, we've got the perfect setup. Is it today? Is the low in? I would give it an 80% probability, but there's a 20% chance it's not. So I'm very focused right now on watching the price structure. And the final thing to give you is the big one for me is ETH breaking about the 2000 level. That will give us an inverted head and shoulders low. And also there's a downtrend from the high, and it would have then broken a wedge pattern to the upside. And that would be the start of the run to new highs whenever that occurs. So that was a lot of information in a short period of time.